Welcome to this first ever edition of the Bear Trap Discord podcast. My name is John Kirby. My co-host is Vic, one of the founders of the Bear Trap Discord. We're going to be using this podcast as a venue to investigate how options drive markets. In order to do so, we're looking at gamma exposure, at skew, at many sorts of different options metrics, and most of the charts that we're using come from, are designed by, created by Oclocracy, another member of our Discord and founder of the Investors Haven Discord. So many thanks go out to him. Both of our Twitters and YouTubes are going to be linked in the description, so we appreciate any feedback. Let's get started.
Anyways, so what happened this week, man? Let's just get into it. What happened this week? You had a thesis coming in. I know this, and it was essentially what, just short vol, right?
Yeah, I mean, I think we both had. Well, I guess you were a little more bullish than I was. I was kind of like directionally ambivalent, but pretty short vol. And I mean, it almost feels stupid at this point, right? Because it's like, okay, last week before OPEX, going into VIX-X, the short vol always just happens. And then the other thing is, after having such a big event, like such a massive volume event like CPI last week, it's not surprising to think that like there's going to be some mean reversion in vol right after it. Also because the eradication of uncertainty is a short vol event, regardless of whether it's bullish or bearish.
100%. Yeah. I mean, we see it over and over and over again. People are always overestimating the tails, right? They price in the tail too much.
Yeah, which is odd because you think that because I remember I've listened to a lot of different podcasts where people will talk about how tails used to be really cheap before the 1987 flash crash, right? And after we had that, then the tails got much more expensive. And it's like it ties into all that literature too from who's that dude that wrote that book on the on like Lepocurtic tails and Taleb, Nassim Nicholas Taleb, like the Black Swan book, right?
Oh no, I've never read it. Yeah, I've never read that.
So basically, those sorts of books are just about how they're like, if everybody uses similar vol models, you get these sorts of feedback loops, which can lead to like Volmageddons, or you can have these sort of systemic issues like the ones that cause the flash crash. So we're always pricing in to have a sort of systemic issue. And that was my thesis with CPI, right? It's like, we're going into CPI at around, a 30 vol, 33, something like that. And the issue was like, if we were really going to have a crash, right? Then you would have seen that 30 go up to 40. And at the point where we're talking to 40 VIX, we're looking at like a real legitimate COVID crash type thing. And with everybody so bearish, it was just hard to see that happen. So it's not that like I was bullish. It's just that it's just so hard to be bearish at that juncture. And as soon as we get something that's just slightly above average, obviously the market like tanks because everybody knows what the options are pricing in. But somebody's got to sell those puts, and then that's when we got that massive reversal, which has been leading to this sort of.
I want to show something because just to your point here, I'm just kind of pulling up charts that I've been watching that, I was on the same page as you when we were hitting these lows. It was like, man, are you seriously trying to buy puts at this particular point in time? I know on the chart, like people look at their chart and I think they get bearish. And this is how I used to be, is you just see a bunch of empty space because there's no support lines under there, right? You're looking at SPY coming back and retesting 360, 350, and there's nothing underneath it going back to like pre-COVID highs, right?
Yeah.
But the issue is you got this crazy skew, man. Do you see this?
I do. Yeah.
And so it's like, I don't think people understand, like, there's no point in trying to buy puts. You're buying puts. Look at the IV levels here. So this is why you're selling puts, because it's like these prices are crazy. And this is just expiries going out. The skew, I'll pull it up maybe if I can find it, but the skew for
exactly. I have a screenshot of that, which I posted on my Twitter because I was looking at it, right? Just kind of and what was amazing about that day was we started with a skew exactly like the one that you're drawing, and then the weeklies flipped, right? Which is what happens before a big vol event. And so the tail end skew actually went down, and it was kind of like a mountain. So the weekly skew was kind of the inverse of the skew of every other option down the line.
Oh, that's interesting. Yeah, I didn't see it. I did not see that one. I didn't see that version of it.
Yeah, I can link my tweet to this, but the
Yeah,
reason that that happens is because as soon as we're getting really close to the event and everybody's already positioned and everybody's already in their options, I mean, my suggestion would be that market makers as well as other market participants can see that the max move we can get is about this much, right? Because you have those giant ass walls. And that actually means that selling those tails becomes super profitable for everybody. So if you time it right and you get the transition from the U to the N, right, on the weeklies, then you make a boatloads of money.
I see. You have to show me, send me that, because I'll pull it up here.
Yeah, I'll do that. I'll do that right now.
See that version of it, but going, yeah. So that's interesting. You bring that up too, because I was playing Snapchat earnings, and I'd been watching it for 2 weeks, and the skew was fine. The skew looked like I'll pull it up eventually, but the skew was like that essentially going into it. And it was kind of pricing in like a $13, $14 move. And then all of a sudden, I'm going to erase these, but all of a sudden, is this the one? Oh yeah, look at that.
Yeah, do you see that? Pull it up. It's crazy. It's fucking crazy.
Okay, let me get rid of some of these. So this was right before what, Wednesday?
Yeah. It was literally the day of the event, and that's what it looked like that morning. Or maybe the evening before, but it doesn't really matter. It was basically DOI right before.
14th. Okay, so this was last Friday. Okay. That's what we're seeing, the skew for last Friday.
Wait, and CPI was Thursday. So was this right after it?
This is right after, where you see that the tails get crushed. That's where the tails got destroyed. So you're probably talking about how you get a situation like this, right before the event.
Exactly. Yeah.
This is what Snapchats look like. Let me see if I can go find, because I want to talk about that one, because it was kind of a lesson for me too, because I got rugged on Snapchat, but it could have been avoided. That's the thing. And I'm going to see if I can find it.
But I think the point that I was trying to make before, and maybe why I was a little bit ambiguous in terms of how I was talking about this, is that I think that the transition from the N to the or from the U to the N rather on the implied vols through CPI, like this is something that we have to imagine happening through the event. It's not like, to me, I don't think it's entirely binary, because as with most events, just before those vols already start to be modified, right? So if you were to sell the tails right before CPI, that's the only way that you would benefit from that crush happening on the tails.
Interesting. Well, you're selling it at like the max fear point, essentially. Like, you know what I mean? Like, you're selling it at literally the best possible moment, because you have the least amount of time left going
exactly
event for something to happen. Yeah. So, okay, I see what you're saying. Well, check this out. So check Snap out. This was what I've been watching. This was, I don't remember when I took this one. This one was on the 17th. Okay. So Snapchat earnings were on the 20th. So this was Monday. What would you say if you were looking at this and you're going, okay, I want to play Snap? What are you trying to do? Are you playing the tails there, or you pricing in something around 12.50? What are you thinking?
I'm thinking that the market's a little nuts, because I mean, look at how even that skew is, right? It's not that it's flat, but the upside and the downside are being priced equivalently almost.
Right.
And normally you'd see downside skews, so I'd be selling calls into that.
Selling calls.
Yeah.
Because it's not skewed. It's a little bit priced to the upside, maybe too much.
Yeah, like let me put it this way. If you're buying calls into that, you're buying some overpriced stuff, right?
Buying overpriced stuff here. So I was selling these calls here, the 15s and 14s. The issue that I ran into is I was actually buying calls here.
Oh,
I was buying these 11s and 12s and just selling this stuff against it. And so over time, so this was the 17th. This was the day of,
mm-hmm.
and then this was the day right before. This was literally right at close. This is what it looked like.
That's amazing.
So
So they
if I would have saw this right at close, right before it happened, I would have closed out of everything.
100%, right? Because if you see that downside skew picking up, sorry, the implied vol and the puts picking up so much, it's because somebody knows something, right?
Well, yeah. And so what happened to all of this? I mean, obviously that might still be there. It might just be a graphical thing, but this dip right here and the pickup here, that right there would have told me, because you're looking at a different story compared to, say, something like this.
Yeah.
What happened here where it caused the drop, right? I don't know. This is just the way I was looking at it. I was kind of always, Ak always told me to look at these, look where the concave is. And that's sort of where the market the market is essentially going to end up going.
Yeah, that's where let me put it this way, that's where the neutral, it's kind of like where the neutral pricing is, right?
Yeah.
And
these
the
people
reason
here don't get paid, yet they probably still do on the crush, but they're not going in the money, and then all these people get crushed, and then we end up right here, and that's pretty much exactly where it went.
Of course, yeah. So from a more technical perspective, if you look at your 50 deltas, 50 delta call, 50 delta put, right? Those are the guys that have the max gamma, right? Because those are the guys that benefit the most from a move,
right.
Because all of a sudden you have like when we say max, and I know you already know this stuff, Vic, but just for, I guess, other people that might be listening, max gamma means that your delta is going to change as quickly as possible.
Yeah.
So if you're expecting a gigantic move, then you want to buy the at the money calls or the at the money puts, because you're going to get an exponential return on that move, supposing that, I mean, regardless of whether you chose the right direction or not, just hopefully it's in your favor. But now flipping the script and thinking about it from the perspective of a market maker, where am I going to put my lowest implied vol? And it's exactly at the point that I expect price to go to, right? Because your lowest implied vol is going to coincide more or less with your highest gamma. That's why we always, whenever we look at skew and we see what's the absolute bottom of the curve, that's always like more or less the at the monies.
Right.
So if you're seeing the lowest implied vol, i.e. the max gamma, be lower than the current spot price, then it's going to tell you, hey, that's where we're going, right? That's where market makers are comfortable selling the absolute scariest stuff to sell, in other words.
Right. Yeah. It's wild what the information you can get from the skew. It like literally just a few lines on your screen, and look what you can imply into the entire chain.
Yeah.
That's another thing too, is combining this with the gamma charts. And then also another thing that I was doing this week was looking at that, and then watching this open interest. I don't know if you ever do you mess around looking at the open interest every day, or?
I don't do it every day. I mean, I was doing it for a long time on the VIX because I kind of wanted to see, what the right the relationship was between like VIX OI and VIX gamma, to see if it was reliable to use the gamma charts or not, that sort of thing. But yeah, tell me what you were looking at there.
Okay, well, my whole thesis this week was, I don't know if it was different than yours as far as just we had the same conclusion looking at the VIX, but my whole thing was, I know this is kind of a naive open interest because we don't know if these are, these positions here, which held all week, by the way, through the entire range. There was hardly any reduction in OI all the way into Friday. And so my whole thesis coming in then to Friday was, are we going to be able to see these levels, these 340s, 350s, and we're trading at 365. what's going to happen when we open up and we come down to test 360 and then we can't break 360? What's going to happen to all these folks? What's your first thought? All those positions that are sitting there.
Well, I mean, my first thought is that it looks like an analogy to what happened on Friday, just
Exactly.
intraday.
And so if you're looking at it here too, these delta curves are coming in here, and it's basically right where we opened is right inside of this delta curve. And all these folks are out of the money, with a day left.
Well, but okay, Vic, I don't think those folks were being stupid. They got
No,
really unlucky.
No, I don't think so. I'm not saying it that way.
Yeah.
I'm saying that, the timing that whoever's positioned here, the timing of whatever catalyst they're waiting for, or whatever, whatever they're scared of, or whatever they're hedging against, it's gone. Essentially, it's the same thing as, you selling vol into the CPI event. It's the same thing. Is you're now at the max point to where these people don't need these positions anymore, or the market makers don't need to hedge against the positions anymore.
Yeah.
And so I was saying, like, there's a ton of fuel here. Now there's still positions, there. I don't know if they're going to be there on Monday, but there's still positions there going out into further expiries.
Oh, and they're going to get screwed month of November. I mean, we'll get into that later, but
I think so. I think so. And this is what Kem is talking about too, is these positionings here going out into, for the vol event, right? So we'll talk about that. But yeah,
it's naive. What that looks like to me is naive macro positioning, right? But that's
right. It's pretty clear though, even though it's naive, if you understand the context of what's going on in the market, you have a pretty good idea of what these positions are for.
Yes. Yeah, of course.
It's not like you're naive, but at the same time, you can make pretty good assumptions on what they are, even though we don't know exactly the positioning.
So let me go into for 2 seconds why they got screwed. And there's 2 reasons.
Okay.
One was because and I don't have that chart right now. There were some wonderful tweets with it. But the Friday expiry, right, which looked exceedingly bearish, right? We had a bullish Thursday SPX, not a lot of gamma there, like 6 million or so to the upside. And then all of a sudden, looking at Friday, you could see that everybody was expecting another one of these bloody Fridays, because we've had so many of these down 2% Fridays in a row now. And I think all things being equal, they would have gotten it, except that so much of the expiry was 20, I mean, on our GEX charts, we were seeing like 20 million of SPX gamma expiring in the AM, so at 8:30, but it was actually a lot more. And it was I think it was like 25% of the overall expiry, which was something like 3 trillion on this OPEX or MOPEX, whatever. And we saw that. I mean, we were looking at the charts, and I remember seeing that tweet from I forget, it was one of those, not Spot Gamma, it was one of those guys. And they tweeted, they were like, yeah, okay, so these SPX guys are going to get settled in the AM 8:30. And they were puts, right? And I think they were probably around 360. It was 3650, meaning that something like 363 on SPY. And so we were down pre-market, get to 8:30, wait 10 minutes, and then all of a sudden, obviously, we bounced because all these guys were off, and we were trading pre-market right at 363, of course, right? And then we get that bounce, and that bounce wouldn't have necessarily been super sustained because we had way more puts coming out, everybody was really bearish, but then we get this leak to the Wall Street Journal, which is something else we got to get into.
By the way, I think what we're tracking, I think whoever's tracking it as well was just like, all we need is a pinprick here.
100%. They know exactly when to release that news.
Yeah.
So that because what the Fed wants, and I mean, this is getting ahead of ourselves a little bit, right? But the Fed wants a real orderly sell off, right? Because they don't care what the overall level of the stock market is. I don't mean to repeat every other,
every Fed speaker every single day is what they're saying.
Yeah. But what they do care about is liquidity. And the reason for that is if all of a sudden we get a 4 or 5% down day, and then we get another one like we got during COVID, all of a sudden there's people out there, or rather institutions, companies that are not sufficiently hedged to take that type of volatility, even though we have, a 30 VIX. And then that's what can cause cracks in the
Yeah.
financial system.
That brings up such a good point. Again, we might be getting ahead of ourselves here because I want to come back to this stuff too. But I was reading about something about the liquidity situation of the stock market, and I don't remember who it was. I think it was on the Top Traders podcast with Jim, and they were talking about how the notional trading value that moves the markets every day is so minuscule. It's
100%.
and
And how much of that is on the weekly expiry, right?
well, it's that, yeah, exactly. So when you're looking at these numbers and you're going, man, it doesn't really seem like that much, but it is. It's so much. I mean, if some huge fund, say BlackRock, sells its Apple, I mean, the market's just gone. You know what I mean? Like, there's not enough people to hold the bid. If just one big fund comes and sells all their position, there's not enough people to buy it.
Yeah.
There's just not enough volume. And so the markets get moved by really small amounts of money when you think about it, a total global scale of things. But so you're so right. So my theory has always been that the Fed, their soft landing plan has been working as they're just short squeezing the bears, get the levels back up to, some reasonable level, and then people can distribute again for a little while. Then everybody gets super bearish and then they squeeze them again. And that's exactly what happened on Friday.
Exactly. And we should mention too, right, that we're obviously looking at equities and equity indexes and so forth, but the real game is happening in the bonds.
In the bonds. Yeah.
And it's the same thing. In this case, the culprit was the 10-year, right? And you can look at this.
We got 10 minutes, dude. We've got 10 minutes because we're running out of time here.
Oh man, okay. Well, all I wanted to say is that the 10-year was way overextended relative to the current Fed funds rate. And that was going to cause global liquidity issues. And what they did is they just reversed the 10-year in one day with one leak. And that's the other reason that, yeah.
Yeah, and it's such an interesting thing. If you look back and you go, well, the 10-year and the dollar super overextended to the upside at the upper bounds of where the Fed would want them. And the stock market was literally on the brink of limit downs, if you really think about it. And that's the exact moment on MOPEX at 8 o'clock, right when the SPX AM expiries, 80% of the gamma for that day was on those AMs. And all they needed was that little pinprick, dude. And it's just like it unleashed the horde.
Yeah, you can't watch this stuff and really be looking and not get suspicious.
Oh, dude, no, you know what? I'm not suspicious. I already know my whole game plan is around what I think they're going to do.
Exactly. And you know what it is? It's so a lot of people think about selling vol as this game of, as a game that has to do with the stock market. And right now, selling vol has nothing to do with the stock market. It's just knowing that there's guys out there who, after a monster CPI, who after some crazy vol event, that it is in the Fed's best interest for everything to proceed in an orderly manner. And I'm going to trade on the side of the Fed. It's that simple.
Yeah, I mean, they're telling you every day. That's why they put those speakers out there every day. And we're going into a blackout period, which is going to be really interesting. But they put them out there every day because that's how they control the markets. You got Kashkari that comes out and says, yeah, we want to keep rates super high, or we want them to go higher, or we're not going to, this, that, and the other thing. And then you got some other Fed person that comes out, well, you know what? We're thinking about a pause, and I've looked back through all the tweets and all the different, blurbs that they put out there. And it's just like, they're never in agreement. They're just talking the market up and down. And it's really 100%. All it is. And so if you just follow that, it's like, it's kind of frustrating because it's like, I really wish it was just a free market in a way, but
I mean, I do too in some sense. And there's also like a pretty significant inefficiency. Like I have a buddy who's been basically just looking at the Fed funds futures, and he'll position himself on the basis of those and what's coming in the next few meetings. And it's actually not that hard to do because you have a market that's reacting on such a short scale time frame, right? We get this one little piece of news and all of a sudden we rally, when we all know that they're not actually, I mean, we're still going to get similar Fed hikes, right? The situation is still bearish. So if you were long term enough, you could definitely get short here. I would wait a little bit. But
I would wait a little bit too, but
there's still alpha there, right? A little bit of it.
Yeah. No, if you understand sort of have it, like you have a good grasp of the framework, the context of what's happening right now. If and you know, I'm sort of getting there. I mean, I've been just trading sort of in a naive Gex world with not much other context, but I'm sort of getting there to understand these cycles between the OPEXs and how the Fed is gaming the liquidity that happens from bearish sentiment
Yeah.
effectively. And then it games the liquidity that happens from bullish sentiment. And so it's just like, once you understand that process, it's really not that complicated of a game.
It's not, then it becomes more of an emotional game, which is what we've been talking about before, which is the question of like, okay, once you get there and you're looking at it and you're like, can it really be this simple? And of course it's not simple, right? Because,
No, it's not simple.
but it
It's not
feels that
easy.
way. Once you're there, it feels that way.
But if you look back at this last couple of weeks, it wasn't that hard. I know a lot of people had difficulty trading. I know that, but it wasn't that hard